Modigliani and Miller approach, which is also called approach, is another important theory of capital structure for determining the value of the firm. And this theory has restated the NOI approach by adding some more assumptions to it are related to the behavior of investors. NOI approach and NI approach, they have not considered the behavior of investor. So this is a restate of the NOI approach, means that approach also using the model of NOI approach with some extra assumptions being added to NOI approach, and that is why it is restated. And this theory is also saying that the value of the firm depends on the earnings rather than the way in which funds have been financed. approach shows that the financial leverage does not matter and the cost of capital and the value of the firm are independent of the capital structure. The value of the firm is capitalized value of net operating income. So the theory has failed to give a single situation. This approach has considered the wider area, including the behavior of investors, their ability, their rationality, switching off from one form to another form, how they can save themselves, how they can make earnings if they switch over from one form to another form. Area of assumptions apart from the NOI approach assumption, so which is explained all the assumptions of NOI approach in my part 2 class. So all of you watch that assumptions. In addition to that assumptions, some more assumptions have been made to justify this theory, accepting the behavior of the investors, and their approach is assumed through and analyzed this theory for determining the value of. So here the first assumption is lying. There is a perfect capital market. This model is based on the following assumptions. All the investors have a complete information about the capital market, that is, it is a security market, the stock exchange, buying and selling of security, and which firm does not have the rationality of investor. Given the due importance, that they have a good analysis capacity on securities. Moreover, the investors are free to buy or sell. There is no restriction to buy and sell of securities. The rate of interest applicable to the firm is applicable to the individual case, though in practice it is not justifiable, but this fact is assumed, and then the investor can design his personal leverage at the same rate of interest which is getting by the firm. There is no transaction cost, no brokerage, no commission for buying and selling of security, and there is no corporate tax. However, this assumption was relaxed later, means it is the tax rate is incorporated, and after incorporating tax, the value of the firm is determined. The investors are rational for switching over from one firm to another firm, and they can switch over from one market to another market, and well informed about the risk return. And in arbitrage process, who own a part of levered firm will be better off selling the holding in levered firm and buying the holding in unlevered firm using his personal leverage. So here the theory has recognized, or the theory has explained, by taking two forms. One is unlevered form, that is no debt financing in its capital structure uses, and another is the debt financing in its capital structure uses. Levered and unlevered form are calculated using the following terms and steps. The value of the unlevered form by capitalizing the profit after tax or profit before tax if corporate tax does not exist. If the corporate tax exists, then after tax. This is the symbol used. Then the value of the firm is calculated earning before interest and tax, but commonly we use this term EBIT. 1 minus T, T stands for rate of corporate tax. Value of earning before interest and tax will be equal to profit after tax. This is to be capitalized. And the value of levered form, that is the form which is using the debt financing as well as equity finance. So the form market value is increased. Then here how to obtain the value of levered form. The value of unlevered form will be increased by the amount of net present value of tax shield, that is the tax saving amount, and the present value of tax saving amount is obtained with the using this formula D into T. T means debt financing into rate of tax. Present value of the perpetuity of interest tax shield is added to the value of unlevered form. The result is value of levered form. Interest is tax deductible, or it is also known as interest tax shield. Annual interest tax shield amount can be calculated by using this formula: debt into rate of interest into rate of value of perpetuity of a tax shield. Here it is calculated D into I into T, that is the total amount of debt multiplied the rate of interest multiplied the rate of tax, and the present value is computed by dividing it the appropriate rate, and appropriate rate is considered here the rate of interest. This by using this formula, or can calculate the cost of equity by using this formula. Here the overall cost of capital, this one, and KD 1 minus T, that is the rate of tax, D by V, and this K value is missing, so we have to calculate the cost of equity by solving this equation. So one is the levered form, another is the unlevered form. Levered form using the debt financing in its capital structure, unlevered form not using any debt financing in its capital structure, and it depends only on equity share capital. So accordingly, this is the question on your screen. Companies A and B are identical in every respect except that the A Limited does not use the debt in its capital structure, while B Limited has a debt of rupees 6 lakh at the rate of 15% interest rate annually. Assuming that all the assumptions of model met, the corporate tax rate is 50%. The company has earning before interest and tax is rupees 2 lakh, and equity capitalization rate of unlevered company, that is A Limited company, is 20%. Find the value of the both the companies and weighted average cost of capital. So earning before interest and tax 2 lakh, K equal Q, that is the cost of equity capital, which is equal to overall cost of capital, because the cost of equity capital is only the cost that the firm has to pay, because this is an unlevered firm. This is an unlevered firm and it has no debt financing in its capital structure. So whatever it is paying, it is only the cost of equity share capital, and that is why it is here cost of equity equal to KO, and the rate of tax is 50% given. Then using the NOI approach model for calculating the value of the firm here. So here value of A Limited and rupees 2 lakh, and rate of tax 1 minus 0.5 divided by 20 multiplied by 100. So total value of the unlevered form is 5 lakh. This represents the total value of equity share as well as the value of the firm, because this is an unlevered firm and it is not using any debt financing in its capital structure. So whole value represent the market value of equity share. Now value of levered firm, the company, that is the B Limited, and it is symbolically VL, value of levered firm. It is obtained value of A Limited, that is the value of unlevered firm, plus tax shield, present value of tax shield, that is D into T. So this is illustrated later on. Rupees 5 lakh is the value of unlevered form, just we got, and rupees 6 lakh is the debt financing in its capital structure, and rate of tax is 0.5. So 5 lakh plus 3 lakh, total value of the firm is 8 lakh. This is 8 lakh. And out of 8 lakhs, this is the total value of the firm, which is including amount of debentures, amount of equity share, and together it is 8 lakhs. So if out of 8 lakhs, if the value of debenture of debt is deducted, the balance which is obtained is market value of equity capital. It is rupees 2 lakh. And now let us see here again the earning before interest and tax 2 lakh, interest on debt 15% of rupees 6 lakh, 90,000 is the interest amount, 1 lakh 10,000, and the corporate tax is calculated on the earnings after interest. So after interest amount, earning after interest 1 lakh 10,000, 50% 55,000, and this is the profit after tax which is available to equity shareholders, 55,000. Now cost of equity capital can be calculated here, profit after tax by S into 100. So this is the 55,000, the value of equity share capital is 2 lakh, multiply, so 27.5% is the cost of equity. Then weighted average cost of capital of A Limited, since it is an unlevered form, weighted average cost of capital is KO equal to KE, because this firm is not using any debt financing, so whole earning goes to equity share capital holders. Weighted average cost of capital is 20%. Weighted average cost of capital of B Limited, that is the levered form, and here overall cost of capital KD, rate of tax is given 1 by minus T, and D the value of debenture, value of debt divided by total value of the firm, cost of equity, value of equity share capital divided by value of the firm. So this is the weighted average cost of capital calculation formula. Putting the value into formula, rate of interest on debenture is given 0.15, and it should be adjusted with the rate of tax, so 1 minus 0.5, this is the rate of tax, and the value of debt is 6 lakh, and total value of levered form is rupees 8 lakh. And in the same manner, the levered form, the cost of equity capital is calculated 27.5% in this here. So this is the cost of equity capital of levered form, 27.5%. 27.5 divided by 100, 0.275. That cost of equity capital 0.275 multiplied by 2 lakh, the value of equity capital, and divided by total value of the 3 house after decimal 3 values, 0.056 plus similarly here 0.275 into 2 divided by 0.069. So here 0.069. So adding these two values, 0.125 express percentage 100, so 12.5%. So DT value is verified with this verification. Listen very carefully, watch it. So earning before interest and tax 2 lakh rupees and 2 lakh rupees, it is constant. Unlevered form as well as levered form, and interest on debt, the amount of interest is not available, it is unlevered form, and amount of interest is available since it is a levered form using the debt financing 90,000. So this 90,000 is the value of debt is 6 lakh and a rate of interest is 15%. This is the 90,000 is the annual interest amount deductible from EBIT. The balance is 1 lakh 10,000, and here the balance will be 2 lakh, and the rate of tax is given 50%, and 2 lakh 50%, 1 lakh, and 1 lakh 10,000 50%, 55,000. This is the net profit after tax, 1 lakh rupees and 55,000. The noticeable point is that unlevered form is paying rupees 1 lakh as tax, and levered form is paying rupees 55,000 only. tax, and the levered form has saved the tax. This is the interest tax shield, and this the amount 45,000 is interest tax shield, and it is calculated here. 1 lakh is the tax paid by obtained, and this is 45,000. So this is the tax amount saved by levered form, and the present value of this tax amount is calculated using this formula: present value of perpetuity, that is this is the non-redeemable debentures, and every year company is going to save this tax amount. On this presumption, the tax shield amounts of present value is calculated using this formula. So total amount of debts rupees 6 lakh into rate of interest, that is 15 by 100, and this is the 0.15 into rate of tax 50%, that is 0.5, and this is the present value is computed with the help of rate of interest on debts. This is a 15%, and here 0.15, so 50 I and I is cancelled, only D and this is the into T left. This T and T value is added with the value of unlevered form to get the value of levered form, and this is 3 lakh present value of perpetuity tax shield. This is the value of unlevered form plus this is D into T. This 3 lakh can also be calculated using this shortcut formula: tax shield 45,000 divided by rate of interest on debenture, this is 0.15, so 45,000 0.15, 45,000 divided by 0.15, the value is 3 lakh. Okay viewers, thank you very much. All of you watch it, like, share and subscribe.